I've been asked to explain what happens when interest rates go up. So essentially, the Bank of England, which is our central bank, it lends money directly to the banks. So if they want to make it more expensive for the banks and therefore for us to borrow money, they will put up the price of borrowing money, because interest rates are basically the cost for borrowing money. I know it's the word borrow. I mean, it's really confusing because you don't expect to be able to pay to borrow something. But, essentially when you borrow money, you really rent it. And that's what the interest rate is. So if we are spending too much, according to the central bank, the Bank of England, and that's making the prices go up, inflation, then they go, oh, we're going to make it harder for people to borrow. We're going to make it more expensive for the banks to borrow. And then they're going to make it more expensive for their clients, you and me, to borrow. So they put up the price of borrowing money. In other words, they increase interest rates. So say it was at 1%, which it was, and then you put it up to 1.5%. That means that it's just that bit more expensive to borrow money. If you've got a mortgage, it makes it quite a lot more expensive to borrow money. So that means there's less money around, less money that people can offer for things, particularly houses or anything that you're buying. So that means that prices can't go up as much as they might have done if there was lots of money washing around and all sorts of people go on, I'll give you this, no, I'll give you that, but that, put the price up. So that's why interest rates have been put up. And that's what happens when interest rates are put up. The idea is that it brings inflation down. Whether it actually does in practice, of course, is a whole other issue.